the Federal Reserve. It sounds like a room full of boring guys in suits, right? Well, think again. These folks control the flow of money in America. They can make or break the economy with a few keystrokes. We're talking about your money, your investments, your future. So buckle up, because we're about to dive into the world of the Fed and how their decisions can make you rich or send you running for the hills. Now you might be wondering, why should I even care about the Fed? Here's the thing. The Fed sets interest rates, and those rates, they're like the gas pedal or brake pedal for the entire economy. Low rates mean cheap money. Businesses borrow, invest, and hire more. Consumers open their wallets, buying everything from cars to houses. The stock market, it usually throws a party when rates go down. But wait, there's more. The Fed doesn't just set rates in a vacuum. They're like economic ninjas, constantly watching for threats. Inflation rearing its ugly head. They might hike rates to cool things down. Recession looming on the horizon. Rate cuts could be their weapon of choice to stimulate growth. The point is, understanding the Fed is like having a secret weapon in your investment arsenal. Because when the Fed speaks, the markets listen. And when the markets move, you want to be on the right side of that trade. Let's get down to brass tacks. What exactly do these Fed folks do to keep the economy humming? Their main gig is something called monetary policy. Think of it as the art of managing the money supply to keep the economy stable. Too much money sloshing around? Inflation could skyrocket? Too little? We could end up in a recessionary ditch. The Fed's favorite tool in their monetary policy toolkit is interest rates. These rates are like the price of money itself. Want to borrow money to buy a house? The interest rate determines how much that loan will cost you. Businesses need loans to expand. Same deal. The Fed sets the benchmark and banks follow suit. Now here's the kicker. When the Fed cuts interest rates, it's like giving the economy a shot of adrenaline. Suddenly, borrowing becomes cheaper. Businesses get excited about investing and expanding. Consumers feel flush and start spending. And the stock market, it usually takes the cue to rally, baby. But hold your horses. It's not always sunshine and rainbows. The Fed has to be careful not to overdo it. Cut rates too aggressively, and you risk runaway inflation. It's a delicate balancing act, my friends. And that's what makes understanding their moves so crucial for savvy investors like you. Let's talk about why you're really here, how Fed rate cuts can impact your precious investments. Historically, the stock market has a bit of a love affair with rate cuts. Why? Because lower rates often signal a pro-growth environment. Investors get giddy at the prospect of higher corporate profits and bid up stock prices. Think of it this way. When rates are low, companies can borrow money on the cheap. They can use that money to invest in new projects, expand their operations, or buy back their own stock, boosting earnings per share. All of this is music to investors' ears, and the market tends to respond accordingly. But here's the thing. The market is a fickle beast. It doesn't just react to the actual rate cuts, it also anticipates them. Remember those economic ninjas we talked about? Investors are constantly trying to anticipate the Fed's next move. So even the mere rumor of a rate cut can send the market soaring. Conversely, if the Fed doesn't cut rates as much as expected, or hints at hitting the brakes, watch out below. The market can throw a tantrum, sending stocks tumbling. All right, enough theory. Let's crack open the history books and see how this rate cut magic has played out in the real world. Spoiler alert, it's been a pretty wild ride. But one thing's for sure, when the Fed has slashed rates in the past, the stock market has often responded with a resounding thank you very much. Take, for instance, the early 2000s. The dot-com bubble had burst, and the economy was sputtering like a busted carburetor. The Fed stepped in with a series of rate cuts, and guess what? The market came roaring back, fueled by cheap money and renewed optimism. And it's not just ancient history, folks. Remember the Great Recession of 2008? The economy was on the brink of collapse, and the stock market was in free fall. The Fed slashed rates to near zero and launched a massive bond buying program. It was a bold move, but it worked. The market stabilized and a new bull market was born. Now, I'm not saying that every single rate cut has resulted in a stock market bonanza. That's just plain wrong. Sometimes other factors are at play, like geopolitical events, oil shocks, or even a global pandemic, for crying out loud. But historically speaking, there's a strong correlation between rate cuts and market rallies. And that's something every savvy investor should have in their back pocket. Section 2, 2008. The proof is in the pudding. Let's rewind to 2008 for a minute. The world was staring into the abyss of a financial meltdown. Banks were collapsing, credit markets froze up, and the stock market was in a tailspin. It was a scary time, even for seasoned investors like yours truly. The Fed, under the leadership of Ben Bernanke, knew they had to act fast and decisively. They slashed interest rates to near zero, essentially making money free for banks. This was their way of trying to thaw out those frozen credit markets and get the economy moving again. But they didn't stop there. The Fed also launched a massive bond buying program known as quantitative easing, or QE for short. This was a whole new level of intervention, essentially printing money to buy up US Treasury bonds and mortgage-backed securities. The goal? To lower long-term interest rates and inject liquidity into the financial system. Now, this was a controversial move. Some economists warned of hyperinflation and other unintended consequences, but guess what? It worked like a charm. The stock market, which had been in freefall, bottomed out in March 2009 and began a historic bull run that lasted for over a decade. Section 3, don't get too cocky. Rate cuts aren't a sure thing. Now, before you go all in on the stock market thinking rate cuts are a guaranteed path to riches, hold your horses. Remember, investing is a marathon, not a sprint. And there are no guarantees in this game, my friends. While rate cuts often give the market a boost, it's not always a straight line to the top. Sometimes the market reacts negatively to rate cuts, especially if it suspects the Fed is panicking or that the economy is in worse shape than previously thought. And remember, the market is forward-looking. It doesn't just react to what's happening today. It tries to anticipate what's coming down the pike. So if the Fed cuts rates, but the market expects even more aggressive cuts in the future, the rally might fizzle out faster than a cheap bottle of champagne. The bottom line? Rate cuts can be a powerful catalyst for the stock market, but they're not a silver bullet. Savvy investors need to consider the broader economic context, the Fed's messaging, and their own risk tolerance before making any investment decisions. Section 1. The market's crystal ball anticipating rate cuts. Here's the thing about the market. It's like that friend who always seems to know what's going to happen before it does. When it comes to Fed rate cuts, the market doesn't just react to the news, it tries to predict it. Think of it as a giant interconnected web of investors, analysts, and algorithms, all trying to get a read on the Fed's next move. And they've gotten pretty good at it too. The market scrutinizes every word uttered by Fed officials, every economic data point, every tweet from the president. Yes, even those. They're like detectives searching for clues, trying to piece together the Fed's thought process. Now here's where it gets interesting. Often the market will start pricing in a rate cut long before the Fed actually makes a move. This means that stock prices might start rising in anticipation of lower rates, even if the economy still looks a bit shaky. Why does this matter? Because it means that savvy investors need to be one step ahead of the game. If you wait for the Fed to officially cut rates, you might miss out on some of the gains. You want to buy the rumor and sell the news, as they say on Wall Street. Whispers and rumors. How the market gets the scoop. So how does the market get its information? Well, the Fed isn't exactly known for being a chatty Cathy. They're more like that mysterious poker player who keeps their cards close to their chest, but that doesn't stop the market from trying to read their tells. One key source of information is the Fed's own statements after each policy meeting. These statements are pored over like ancient scrolls, with every word and phrase analyzed for its potential meaning. Is the Fed sounding more dovish, likely to cut rates? Or are they hawkish, likely to raise rates? The market hangs on their every word. Then there are the speeches and interviews given by individual Fed officials. These can be even more revealing, as officials sometimes drop hints about their economic outlook or policy preferences. Of course, they always try to be careful, but the market is like a bloodhound, sniffing out any scrap of information it can get. And let's not forget about economic data. The market closely tracks key indicators like inflation, employment, and GDP growth. If the data starts to soften, the market might start betting on a rate cut to stimulate the economy. It's all connected, folks. Volatility ahead, fasten your seatbelts. Now, here's where things get really exciting or terrifying depending on your risk tolerance. This whole game of anticipation and speculation can lead to some serious market volatility. Why? Because the market is essentially making bets on what it thinks the Fed is going to do. And sometimes those bets go wrong. Imagine this. The market is convinced the Fed is about to cut rates. Stock prices have been steadily climbing in anticipation. Then the Fed announces no rate cut. Maybe the economic data wasn't as bad as they feared, or maybe they're worried about inflation. Whatever the reason, the market is caught off guard. What happens next? Well, it ain't pretty. Investors who were long on stocks expecting prices to rise might panic and sell, sending that market tumbling. This can create a ripple effect as fear and uncertainty spread through the market. The opposite can also happen. If the Fed cuts rates more aggressively than expected, the market might surge higher, fueled by euphoria and a rush of cheap money. It's like a game of chicken between the Fed and the market, and sometimes it feels like a roller coaster ride with no brakes. Reading the economic tea leaves. Now, here's the thing about Fed rate cuts. Their impact on the stock market isn't always so straightforward. It's not like you can just shout rate cut and watch the market automatically soar like an eagle on Red Bull. The broader economic context matters, folks. It's like trying to bake a cake. You need the right ingredients in the right proportions, or you'll end up with a soggy mess. The economy is a complex beast with all sorts of factors influencing its mood swings. Inflation, unemployment, consumer confidence, geopolitical events. It's enough to make your head spin. The Fed has to consider all of these factors when deciding whether to cut rates and how aggressively to do so. Sometimes the economy is clearly struggling. Growth is sluggish, unemployment is rising, and businesses are hesitant to invest. In this scenario, a rate cut can be just what the doctor ordered. It's like a shot of adrenaline to the heart, making it cheaper for businesses to borrow and invest and for consumers to spend. The stock market usually cheers this kind of intervention, interpreting it as a sign that the Fed has their back. But there are other times when the economy is humming along quite nicely. Growth is strong, unemployment is low, and inflation is in check. This is the sweet spot, the Goldilocks economy that everyone dreams of. In this scenario, the Fed might still cut rates, but for different reasons. They might be trying to prevent the economy from overheating or to stay ahead of potential threats on the horizon. Section 2. Rate cuts in a recession, a life raft for the market. Let's talk about recessions, those dreaded economic storms that can send shivers down even the bravest investor's spine. When the economy contracts for 2 consecutive quarters, it officially enters recession territory. Businesses shutter, unemployment soars, and the stock market usually takes a nosedive. It's not pretty, folks. In these dark times, the Fed often steps in as the cavalry, wielding rate cuts as their weapon of choice. The goal? To stimulate borrowing, spending and investment, essentially trying to jumpstart the stalled economic engine. Think of it as a life raft for a drowning economy, and hopefully the stock market along with it. But here's the catch: rate cuts in a recession are a bit of a double-edged sword. On the one hand, they can help to stabilize the economy and prevent a full-blown depression. On the other hand, they can also signal to the market that the Fed is really worried, that things are even worse than they appear. This can create a fear-driven sell-off as investors head for the exits, further depressing stock prices. So, how does the market react to rate cuts during a recession? It depends. If the cuts are seen as proactive and decisive, the market might rally, interpreting them as a sign that the Fed is in control. But if the cuts are seen as reactive and desperate, the market might panic, interpreting them as a sign that the Fed is losing control. It's a delicate dance, my friends, and the market is a fickle partner. Section 3. The Goldilocks scenario: rate cuts in a strong economy. Now let's imagine a different scenario. The economy is firing on all cylinders. Growth is robust, unemployment is at record lows, and inflation is tame. It's the Goldilocks economy, not too hot, not too cold, and everyone's feeling good. So, why on earth would the Fed even consider cutting rates in this rosy environment? Well, remember those economic ninjas we talked about? The Fed is always looking ahead, trying to anticipate potential threats to economic stability. They know that even the strongest economies can stumble, and they want to be prepared. Sometimes they might cut rates as a preemptive measure, a way to give the economy a little insurance policy against future shocks. Think of it this way. If the global economy is slowing down, or if trade tensions are rising, the Fed might cut rates to cushion the blow and keep the US economy humming along. They're not panicking, they're just being prudent, like a good chess player thinking several moves ahead. So, how does the market react to rate cuts in a strong economy? Again, it depends. If the cuts are seen as a sign of confidence, a belief that the good times will keep rolling, the market might cheer and continue its upward climb. But if the cuts are seen as a sign of worry, a fear that trouble is brewing on the horizon, the market might react negatively, interpreting them as a signal to batten down the hatches and prepare for a storm. Section 1. Playing the field. Which sectors win with rate cuts? All right, enough about the economy as a whole. Let's get down to the nitty-gritty. Which sectors of the market tend to benefit most when the Fed cranks down those interest rates? Remember, investing is like playing a game of chess. You want to anticipate where the pieces will move to make the smartest plays. When rates drop, money gets cheaper to borrow. That's great news for companies that like to spend big on growth or carry a lot of debt. Think of sectors like technology, consumer discretionary, stuff we want, not need, real estate, and even financial. These bad boys tend to outperform when the cost of borrowing is lower than a limbo champion's bar. Technology companies, especially those hungry for expansion, love to gobble up cheap debt to fund research and development or acquire smaller rivals. Lower rates, it's like giving them a bigger shovel to dig for gold in Silicon Valley. Consumer discretionary companies, well, when rates are low, people tend to feel wealthier and more likely to open their wallets for that new car, fancy vacation, or the latest gadget. It's all about spending, baby. Section 2. Tech titans riding the wave of innovation and cheap money. Let's talk tech, shall we? This sector is like the rock star of the stock market, always innovating, always disrupting, and often delivering eye-popping returns for investors. And guess what? Tech companies tend to thrive in a low interest rate environment. It's a match made in Wall Street heaven. Think about it, tech companies are all about growth. They need to constantly invest in research and development to stay ahead of the curve. They need to expand into new markets and acquire promising startups. And to do all that, they need access to capital. That's where cheap debt comes in handy. When interest rates are low, tech companies can borrow money at bargain basement prices. This allows them to fuel their growth engines without breaking the bank, and as they grow, their earnings, hopefully, grow too, which can lead to higher stock prices. It's a beautiful cycle. But it's not just about borrowing money. Low interest rates also make it cheaper for consumers to finance big-ticket tech purchases. Think about it. When was the last time you paid cash for a new smartphone or a giant flat-screen TV? Most people finance these purchases, and lower interest rates mean lower monthly payments. Music to the ears of both consumers and tech companies. Section 3. Consumer spending spree cashing in on the rate cut party. Now let's talk about the consumer discretionary sector. This is where you'll find all the fun stuff. Cars, clothes, restaurants, travel, entertainment, you name it. Basically anything you don't absolutely need to survive, but which makes life a whole lot more enjoyable. And guess what? This sector tends to party hard when interest rates drop. Think about it. When rates are low, borrowing money becomes cheaper. Suddenly that new car loan doesn't seem so daunting. That dream vacation becomes a little more attainable. That new wardrobe upgrade, why not? Consumers feel wealthier and more willing to splurge when their monthly payments are lower. And it's not just about big-ticket items. Lower interest rates also make it cheaper to carry a balance on your credit cards. Now, I'm not saying you should go out and rack up a ton of debt, but let's be honest, a little retail therapy never hurt anyone, right? Especially when the cost of borrowing is lower than a snake's belly in a wagon rut. So when the Fed cuts interest rates, keep an eye on those consumer discretionary stocks. They might just surprise you with their agility on the dance floor. Real estate building wealth on solid ground and cheap mortgages. Let's talk about real estate, baby. It's the American dream, right? Owning a piece of that land of opportunity. And guess what? When interest rates drop, that dream gets a whole lot more attainable for more people. Why? 2 words: mortgage rates. See, when the Fed cuts rates, mortgage rates tend to follow suit. And when those rates dip lower than a gymnast doing the splits, it's like a starting gun for the housing market. Suddenly, those monthly payments become more manageable, and more people can afford to buy their dream homes. And when demand for houses goes up, you know what happens? Prices start climbing faster than a squirrel up a tree. But it's not just about individual home buyers. Real estate companies, especially those that own and operate commercial properties like shopping malls, office buildings, and industrial warehouses, also love them some low interest rates. Why? Because they often carry a lot of debt to finance those big, beautiful buildings. Lower rates mean they can refinance their debt at lower rates, saving themselves a boatload of money. It's like getting a free pass to the money printing press. And with that extra cash, they can invest in new properties, upgrade existing ones, or just line their shareholders' pockets with juicy dividends. It's a win-win. Financials don't bet against the house, especially when rates are low. Now, some folks might shy away from financial stocks, thinking they're too complicated or risky. But here's the thing. Financials are like the house in a casino. They might not always win big, but over the long haul, they tend to come out ahead. And when interest rates are low, that's when the house really cleans up. Think about it. Banks make money by lending money. They borrow money at one rate and lend it out at a higher rate. The difference between those rates, that's their profit margin, baby. So, when the Fed cuts rates, it's like giving banks a wider playing field to rake in those profits. But it's not just about banks. Insurance companies, asset managers, and credit card companies also tend to benefit from a low interest rate environment. They can invest their premiums and deposits in higher yielding assets, generating those sweet, sweet profits. Now, financials can be a bit volatile, especially in the short term. But over the long haul, if you believe in the power of the American economy and the ingenuity of its financial institutions, then betting on financials, especially when rates are low, can be a smart move. Your winning portfolio top stock picks revealed. All right, folks, you've been patient, and now it's time for the main event. I'm about to reveal my top stock picks. The companies I believe are best positioned to capitalize on the current economic climate and a potential wave of Fed rate cuts. But remember, this is not financial advice. Do your own research, consult with a professional, and invest accordingly. First up, we're going straight to the tech titans. Microsoft, the software and cloud computing behemoth, is a no-brainer. They're like the 800-pound gorilla of the tech world, and they're only getting stronger with their dominance in cloud computing, artificial intelligence, and gaming. Current price, $328.66. Next up, we're talking about NVIDIA, the graphics chip powerhouse that's become synonymous with artificial intelligence and high-performance computing. They're like the Ferrari of the chip world, fast, powerful, and always pushing the limits. Current price, $485.09. Now let's move on to the consumer spending spree. We can't talk about e-commerce without mentioning Amazon, the online retail juggernaut that's changed the way we shop. They're like the Walmart of the internet, with their fingers in everything, from groceries to cloud computing. Current price, $137.85. The final word, timing is everything, and so is a good financial advisor. In conclusion, esteemed investors, we have delved into the intricacies of the Federal Reserve, examined the historical ramifications of rate cuts on the stock market, and identified key stock selections poised to benefit from a low interest rate environment. However, it is imperative to remember that timing is paramount in the realm of investing. Even the most promising stock selections can falter if acquired at an inopportune moment. Recall those economic experts we discussed? Their movements are not always predictable. The market can shift abruptly, and what appears to be a secure investment today could result in a significant loss tomorrow. Therefore, it is crucial to remain informed, agile, and always prepared for unforeseen events. Additionally, while I'm pleased to share my insights and stock recommendations, I'm not your personal financial advisor unless you are among those who engage my services with bespoke advice. Each financial situation is unique, and what may be an excellent investment for one individual could be detrimental for another. Hence, it is essential to consult with a qualified financial advisor who can evaluate your specific needs, objectives, and risk tolerance. They can assist you in developing a tailored investment strategy that aligns with your long-term financial goals. Whether you are saving for retirement, purchasing a property, or simply seeking to enhance your wealth. Remember, investing is a marathon, not a sprint. Pace yourself, make informed decisions, and enjoy the journey.